Dear viewers, welcome to this new session of Gurugyaan with BSmart Business Standard. In this episode, you will hear from Mr. Chanakya Chakravarti. Mr. Chakravarti is a global real estate investor and capital strategist with nearly 3 decades of experience deploying and reallocating institutional capital across emerging markets. Most recently, he served as a head of indirect strategist for Asia Pacific at Ivanhoe Cambridge. An alumnus of Harvard Business School, he has held top leadership position at JP Morgan Chase and Co., Cushman and Wakefield and other premium firms. So let's jump into the session.
Hi, Mr. Chakravarti. A very, very good morning. And, we are very pleased to have you with us today in this new session of Gurugyaan. Thank you so much for joining in.
Today's brief was to talk about how a global real estate investor manages geopolitical risk. I wanted to start by adjusting that brief slightly because I think it leads to a more useful conversation. By the time a geopolitical event is actually in the headlines, let's say a border closure, a sanctions announcement, or a currency movement, unusual currency movement, the capital decision has already been made. The position you're holding when the news breaks is a position you've committed to months or even years earlier under different assumptions. So isn't really a talk about reacting to crises. It's about how you build a portfolio that doesn't need rescuing in the first place and how you stay operational when something does land on you. And real estate is a useful lens, in my view, because it forces the question more honestly than most asset classes. Why? Because it's illiquid, long dated, locally regulated, currency exposed, and you don't get to change your mind quickly. So the thinking has to be upfront. Here's the idea I want to leave you with. Most people, including professional investors, treat diversification as a number. They count countries, they count sectors, put it on a pie chart. In my view, the more useful way to think about it is as a sentence. And the sentence goes something like this: these two positions would only fail together if the following thing happened. And then you write down what that thing is. If the thing that you've written down is genuinely uncommon, something specific, something that needs several unrelated forces to line up, then you're diversified. If it's something ordinary, like dollar funding tightening, or one regulator changing its mind, or one shipping lane closing, then you're not really diversified. You just have more line items. That habit, trying to write that sentence, is probably the most portable thing I can leave with you today. Let me make this more concrete with three situations I have been part of during my career. June 2020, middle of COVID, borders shut, most investment committees paused or playing defense. We did the opposite. We recommended increasing our stake in a logistics platform we already knew well. Why? There were two reasons. The first was defensive. We wanted to ring fence the position where the geopolitical blowback was likely to land. The second was more contrarian. The asset class was fragmented. Logistics in this market wasn't somewhere you could just write a check and assemble a portfolio in 12 months. It needed years of relationships and on ground execution, which meant something specific. When an asset class is fragmented and hard to assemble, whoever has already built scale becomes the only realistic buyer for the rest of it. That scarcity gets paid for at exit. 3 to 4 years later, when we actually monetized the portfolio, it attracted more than a dozen bids when we put it to market. The takeaway for me is that the structural reason a position is more valuable often becomes clearer in a dislocated environment. If you understand why you own something, The environment proving the thesis should make you more confident, not less. The mistake is to confuse environmental noise with thesis failure. They're not the same thing. And learning to tell them apart is most of an investor's job. The second situation was a public market position in a listed regional platform. Strong management team, great execution capabilities, but the platform had material exposure to a significant Asian real estate economy. And the macro picture there was only deteriorating in a way that, in our view, wasn't going to reverse on the timeline we really cared about. The path to monetizing those positions was narrowing. The market view at the time was to stay invested. There was more alpha to capture, the team would execute through it. Our view was that the team was as good as advertised, no problem. That wasn't the question. The question was, what were they operating into? A great team running into a closing market doesn't necessarily produce a great outcome for an investor who's operating on a defined horizon. The operator and the environment they are operating in are really two different investments. And you have to be very honest with yourself about which one you actually own. In this case, we booked profit. It was a multi-bagger exit. The market continued to deteriorate after we left. The takeaway here is the harder one. Discipline against consensus is not the same thing as being contrarian for its own sake. We weren't betting that the team would fail. All we were saying was that even if everything we admired about this team was true, the structural thing they were swimming against was much bigger. The market trend tends to reward you for staying loyal to the story, and the portfolio rewards you for separating the story from the environment around it. A third situation. In early 2020, we backed a life sciences office and lab platform in India. The deal closed in the same quarter, coincidentally, when COVID struck. Timing was purely coincidental. The thesis was not. The thesis was about friendshoring, the reorganization of global supply chains, including drug discovery and manufacturing, along geopolitical rather than pure economic lines. India is a serious participant, as you know, in that reorganization. There's also a second layer that often gets missed. The country has a substantial domestic demand for primary cheap drug discovery aimed at diseases that the global pharma industry underinvests in. Exactly why? Because it's cheap. Tuberculosis is an obvious example. So the platform we backed wasn't a bet on a headline. It was a bet on physical infrastructure that geopolitical reordering needs to actually function. Labs, specialized office space, tenants who do this work for a living. COVID arrived, thesis didn't change. Platform continued to perform. The takeaway from this one is the least intuitive in my thinking out of the three. Sometimes the best protection against geopolitical risk isn't to hedge it, it's to invest into the reordering itself at the layer where the new infrastructure is being built. Let me close on the operational side because the brief actually asked about crisis preparedness specifically, and I don't want to skip it. The way I think about it is that portfolio construction is what lets you avoid most crises. Operational preparedness is what lets you survive the ones you can't avoid. Both matter. Students and investors consistently underestimate the second one. Three things in the order I usually see them go wrong. First, liquidity. Liquidity is a position. It isn't what's left over after you've deployed the fund. It's something that you build deliberately, hold deliberately, and pay for deliberately. The reason it matters is that liquidity is what lets you act when other people are being forced to act. Build it before you need it. By the time you need it, the price of the asset has gone up. Second, refinancing risk. Most real estate failures aren't asset failures. The asset is fine. Tenants are paying. Building is full. The failure is that debt has to be rolled, and the market it has to be rolled into isn't the market the debt was originated in. If you haven't stress tested your book against a refinancing environment that doesn't look like today's, you haven't really stress tested your book. Third, governance. Governance under stress. Decide in advance who decides. In a real crisis, you don't get to use the decision process you wrote down. You use the one you are actually practicing. So make the practice good in advance. One thing for you to do this week, I would recommend, take the next investment memo you read or the next case you're given, pick the two largest positions in it and write down the sentence. These would only fail if X happened. If you can't finish the sentence, you've found a problem. If X is something ordinary, you've also found a problem. Either way, you've learned something that the pie chart wouldn't have told you. That habit, trying to write down that sentence, is the closest thing I have as a single piece of advice on this topic. It's worth practicing before you need it. Thank you.
Thank you so much, Mr. Chakravarti. That was really insightful, and I'm sure that it will be a great learning session for all the management students, all the viewers, who will be watching this interaction. Uh, we love to have you in this session, and we are very hopeful to stay connected with you and have you again in any of the future sessions of Be Smart Business Standard. Thank you so much.
Thank you. Bye bye.
Bye. Bye.
Thank you, Mr. Chakravarti, for that insightful session. Be smart viewers, we hope you loved this session. Please share your queries and feedback at bsmart.edit@bsmail.in and follow us on LinkedIn and Instagram for more such insightful and inspiring content. Until next time, keep learning, keep growing.